the US for decades has been the pillar of free trade. We, even after the step back yesterday, we have the highest tariffs in effect right now that we've had since the 1930s. We are one of the highest tariffing nations in the world. Now, we're not talking about all the other non-tariff taxes that other countries put on us, just in a raw tariff level. We haven't had this for, what is that, almost 100 years, 90 years. That is making people question, is the US what it's always been, a champion of free trade? And it appears that that is no longer the case.
Good evening and welcome to our special edition of Rise Up. Each week on Rise Up, we really dig into what's happening with the market, really helping our viewers, you, understand what's going on. This week, again, we've seen extraordinary market upheaval, lots of change going on. I know you've been really listening and understanding what's going on in these highly volatile markets. We want to provide actionable advice to help you protect and grow your portfolio. My name's Terri Kallsen, and I'm a managing partner at Rise Growth. I'm also a certified financial planner, and I'm joined here with my co-host, Joe Duran, who's also a CFA and a managing partner at Rise Growth and one of the leading entrepreneurs, leading RIAs in the wealth management market. Welcome, Joe. How are you doing during this?
I'm good, Terri. I'm wearing my seatbelt today because it seems like every day we're either shooting to the moon or falling down from the moon. And boy, the last week has been really something to behold, not necessarily in a very nice way, obviously. It's been incredibly volatile on the up and the down. And we're going to have a really action-packed session today. We've got, obviously, two amazing people to help us through this. Todd, who's a CFP like you, and Ben, who's a CFA like me. So we're able to talk about money as well as life and how it intersects. We're going to talk about it all today, obviously, Terri, and we're really glad to have you hosting today's event. I think this week, was a reminder of the price you pay for uncertainty. And while we have a little bit more clarity about the tariffs, we have a lot of uncertainty about their intention and the reason we have them and what we're going to do about it. So it's certainly been exciting. We hope that at the end of this session, people who are listening and watching will have a lot more comfort about how to think about what's happening, and then most importantly, how to deal with it in their portfolios and their personal lives.
That's right. I'm so happy to have, both Todd and Ben with us today from Grimes, an excellent RIA wealth manager, a fiduciary, which means we're here to do what's right for clients. So thank you, Todd, and thank you, Ben, for joining us today.
It's good to be here.
Awesome.
Thanks, Terri. Glad to be here.
Well, it is April 10th. I just like to point that out because the world can change in just a few hours or 24 hours. But we're just going to go over a couple of the stats today in the marketplace. S&P was down 3.46, closing at 52.68. We're starting to see the Dow Jones Industrial Average dropped about 1,000 points or 2.5%. There's just a lot going on in the marketplace today. It's making people so incredibly uncomfortable overall. So Ben, can you tell us what happened today?
Sure. Well, very obviously the story starts yesterday, right? We had what we like to say is friends don't let friends start a trade war. And so we saw a lot of feedback in the market coming towards the President Trump's policies on trade. It started over the weekend with Bill Ackman, and then we started seeing other people join in, Jamie Dimon, Ken Griffin. These are highly valued advisors or people whose opinion President Trump put some value on. And so you started to see this pushback coming over the weekend, like, maybe these tariffs aren't the best idea the way we're rolling them out. And so the big, it all came to a head on Wednesday, and it was, President Trump saying, listen, we're going to delay these tariffs 90 days. And in doing so, we saw the big market reaction, S&P up 10%, oil was up $5, all wonderful things. The big driver was, from President Trump's standpoint, was what was going on in the bond market. That's been really what the weird thing is. Normally, when you see a sell-off in the stock market, you see people going risk off. What does that mean? They buy bonds and rates come down. Well, what started happening is interest rates flipped around and started going up because people were selling bonds. And we saw the 10-year go from 390 at its low both Friday and then also Monday morning, got as high as 4.5 on Wednesday morning. And so when that happened, that's a 60 basis point move. It was the biggest 3-day move in the 10-year we've seen since 2001. Huge, massive move. And so the feeling was the Treasury market was starting to fall apart. And when the Treasury market falls apart, that means the financial markets are falling.
And I'll just add, Terry, you have a lot of people who use the 10-year bond as leverage, a lot of people with a lot of leverage. And the two things that are being fundamentally questioned here for the long term. Number one, the US for decades has been the pillar of free trade. We, even after the step back yesterday, we have the highest tariffs in effect right now that we've had since the 1930s. We are one of the highest tariffing nations in the world. Now, we're not talking about all the other non-tariff taxes that other countries put on us, just in a raw tariff level. We haven't had this for, what is that, almost 100 years, 90 years. That is making people question, is the US what it's always been, a champion of free trade? And it appears that that is no longer the case. Number two, probably even more important, we have always been the world's safe haven. And so whenever you've had a crisis, whether it was the COVID pandemic, where it was even the global financial crisis, which was a US-led financial crisis, even then, interest rates went down because people went to the Treasury, and the dollar went up because it was the world's reserve currency. And in this case, for the first time in certainly my investing lifetime, which was over 35 years, it was a government policy-led crisis. Usually, it's an external, exogenous event that occurs, COVID, banking crisis, and the government's policies are there to address it. So it is very disorienting on those three fronts. We're now anti-free trade, which is odd. Secondly, again, at first it was about equaling tariffs, which I think almost everyone agrees we're being taken advantage of. But it appears that it's more than that. We want to have permanent tariffs. We're very proud of the billions of dollars that we're now taxing on products coming in. The second is, if we're not the world's reserve currency, if we aren't the people pushing free trade, buying the most products, then what currency, which government should people go to? It's not a coincidence. The Swiss currency shot through the roof today. Mm-hmm. And then lastly, what's the policy? What's the predictability, the consistency that we've always been a nation that operates a certain level of ethos, especially with our friends. And again, this isn't to say that any of this turns out badly. It's just a complete adjustment. And the level of investment confidence, CEO confidence, hasn't seen this since we had the COVID pandemic. So uncertainty is as high as it could be. And all of these things, again, reflected very strongly. I think it's great that the president heard the feedback and adjusted, but then, immediately takes tariffs to China to 125%. And it's like, what are these companies meant to do with that? And nobody knows if it's going to be taken away tomorrow, right, Ben?
Actually, President Trump corrected the market's expectation. He said it's actually 145%. He didn't want anyone to be wrong on that one. And so that's exactly it. So that's why today's, we see the pullback today. People still digesting. And so the question is going to be exactly as you said. All right, we've pulled back on these other countries. What are we doing with China? But still, the really big question is, how are these countries going to get on the good side? And that's the really big question that we're looking at. That's really what the market wants to know. Who's going to be the first person to go in and, talk and say, here's the solution. You have to do X, Y, and Z, and now you're on the safe list. That's great. Is it hard? Is it easy? We don't know. So the positive was, whether it was the market with its bond market and stock market vigilantes stepping in, whether it was the advisors stepping in and saying things. It was good to see some response to that, but absolutely, this would be just the first of 9 innings at least.
Well, we know it's not just tariffs, right? Japan flew out. They flew their delegation. They said we'll go to 0 tariffs, and we sent them away saying not good enough. So we know it's something bigger than just removing tariffs. Like that obviously is not good enough. And I'm not sure how you calculate what else there is. How do you put a price on their regulations and their systems? I don't know. I mean, it's good again, and I don't think anyone really knows, right?
Yeah, I don't
Absolutely.
remember a time in history when there was such a need to be on the good guy list or the good gal list, right? This is a new happening for us. But I really appreciate our CFAs. So our CFAs tell us what's happening in the investment market. They tell us, what their prognosis is. I know you guys have a crystal ball, so thank you for that. But our CFPs now are really going to help our investors, think about what does their plan mean? How do they adjust to this? Because Ben, you said it's nine innings at least, right? We're just starting this. So how do we help our viewers? And I came across some research just recently from Cerilli Consulting. I know you guys have heard about Cerilli Consulting, and our investors today, for the most part on this show, are really a lot of them are self-directed. So the Cerilli data is talking about some of our viewers that in times like this, 22% of self investors, these are do-it-yourselfers, they find it crucial to have a time to talk to a professional. They're asking for help, they're asking for guidance and advice. And they also found that investors who actually work with a CFP are more confident about their portfolios. And so, they're thinking about their financial anxiety. How do they actually have fewer fights at home? There's actually data that says if you work with a CFP, they had 42% lower fights at home. I don't know if that's with spouses or children or friends and neighbors or whatever. But Todd, you're a CFP. If a self-directed investor reaches out to you, what would be the three things that you would try to help them get through this today?
To boil it down to three main points, that's really challenging because I just want to give a laundry list of advice. But if I was going to choose the top three, I would say, people need to think long term. These short market swings are massive. The market feels schizophrenic. Your instinct will always say you need to act fast. You see the market going up 3,000 points, you want to jump in because you think that tomorrow is going to be the same. But typically that's the worst move possible. You look like a hero one day, you end up a zero the next. Short-term investors have gotten caught up day in and day out with various sorts of FOMO, whether it be the meme stocks, the tech trades, Magnificent Seven. They're searching for the quick win. So what I would say is, number one, absolutely think long term. But number two, revisit your plan that you've created. Talk it out. Is this a logical or irrational move? What Joe said earlier, it really speaks to what's happening right now. 2008, that was the mortgage crisis, dot-com bubble. That was obviously, with all the tech stocks there. This is a reversible risk, and it changes like that. So it's really hard to see clients go in all at once, get the quick buck, and then overnight the market goes down 1,000 points.
And Todd, I'd add one thing just to add some color here. It matters where you are, right? Like if you're still accumulating assets and you're still not in retirement, these setbacks allow you to buy and not be as concerned. If you're using your principal to live, you don't want a dollar cost average out in a declining market. So I think your plan has to be different if you're retired versus if you're not. And having a safety net that gives you 3 to 5 years so that you don't have to tap into it. Terri, as a CFP, I know you talk about this a lot. Mm-hmm. It's the key. Like you have to adjust your thinking. Now, everyone needs to invest for growth because we're all living for a really long time. But mental accounting for most human beings is how you get through this mess. Like you have to be able to say, I have 5 years or 10 years or whatever's the right amount of time safely in the bank and in bonds and in cash. And what happens now doesn't matter because I have 5 years, and it's very few 5-year periods where you've been underwater. And so again, and you can also own stocks that have dividends. You can mix your portfolio allocation within stocks to have a very different outcome. I know both of you are very big proponents of being very cautious in the way you invest in stocks, so you're not overly exposed to what happens with the Mag 7 or any one area. Maybe talk a little bit, Ben. I'd love to hear just on the. By the way, Todd, I don't think you said your third thing, so let's make sure we hear that.
You stole my thunder. That is
Sorry.
actually what I was going to say. Is look at your
Sorry.
portfolio as a bucket system. You have your short term, you have your intermediate term, you have your long term. And I don't need to repeat what you just said, but that's exactly right. Point to your cash as your short term buckets. Don't sell equities to fund your living expenses right now. So.
Got it. Ben, I know you actively manage portfolios, something very few firms do anymore. They all seem to just go into models and have a nice day. So tell me a little bit about how you went into this market, how you think about which asset classes tend to do better in an environment like this. I know a lot of our folks listening would love to hear how somebody with billions of dollars under management has been approaching this going in and how you're thinking about it now.
Sure. So the aforementioned unpredictability is the biggest challenge that we're looking at, and simply, what the magical tariff formula turned out to be last week, how that's going to play out, whether those tariffs are going to continue is a huge question. I think the first thing that we do as a firm that's most important is we have a lot of tools that are focused on risk management. And the interesting thing was, they actually started kicking in late March because we were starting to see the tariff headlines pick up. You're seeing volatility pick up. And so in several of our portfolios that have these risk controls, we started building up cash prior to the big pullback we saw on April 2nd or April 3rd after April 2nd. But it wasn't because we had some great insight as to what was going to come out of that meeting. As we clearly established, no one knew what was going to happen in the Rose Garden that day, right? So it's just simply looking at the signals. We always say we have our models, we have our signals, we read, react. Sometimes it feels weird when we're doing stuff as those models are going off, but we take those steps. And again, it's never on or off, right? It's not a light switch, clicks on, clicks off. It's a dimmer switch. So what we do is we have tools to slowly build up a little bit of cash when we see signs of risk rising. But then we also, the important thing, just as important, we have those same tools to help us figure out when risk is coming back down so we can get back into the market. Every market downturn, I'm sure we're going to hear about it in a week or two. Wall Street Journal, Barron's, whatever. So-and-so was out of the market. They called it perfectly, right? Well, how's that person going to get back in? Where's the decision process there? And so it's doing both. It's having some dynamic risk controls to manage the portfolio, but also it's having a portfolio that from the get-go is designed to deal with this market volatility. So
I think that's been a very unusual way nowadays. It used to be very popular when we'd have big swings in the 70s and 80s to have a more tactical approach where you don't just say, I'm going to sit on my hands under all circumstances. I know that what you're doing has two elements. Number one is, are things expensive right now? And should we be going to assets that are less expensive? That's a fundamental approach to the underlying portfolio. And then you add this tactical element that's quite unusual, which is, hey, we're watching this every day. And as things decline a certain amount, we're going to build up cash to just not experience more. And then slowly as things stabilize, again, that in a whipsaw market isn't great, but if it's a trending market like you have, these slow, which is where the pain really happens, obviously, these big protracted bear markets, which everyone forgets in 2000, there was that initial step down when the bubble burst and value stocks did great through 2000. But then in 2001 and 2002, we had an actual recession and everything went down. And it was a 50% decline on the S&P 500. But if you have tactical strategies that slowly build up cash and professionally build it back in, you can actually participate in these multi-period upswings as well as downswings. So I think those are the elements. You don't want to do this as a hobby, obviously.
But the real key to it comes back to the advisors at a firm, folks that are in Todd's shoes, know we have these tools. They know how they work. So when they're constructing a client's portfolio, we have long-only strategies. We have the risk control strategies. We have the fixed income strategies. They know how to mix them together, right? So that way, when something like this happens in the market, the different tools are doing different things, right? The long only, if you go look at your portfolio right now, the long only stuff is the hardest hit. Why? Because things that are long go down. But guess what? You want that exposure on a day like yesterday when the market
Sure.
explodes like that, right?
So Ben, let me ask you a question. I'm a retail investor. I'm watching this show. Which assets today in the S&P 500 in the indexes, like which asset classes within the S&P? Is it big companies or small companies? Is it US or international? Is it any particular sector? How would you think about where I should be looking with concern at what I own? Because again, if we're leaving a period potentially where the US is preeminent, and we've outperformed for a decade now, and we're now, should you be looking more at international stocks? Is this a time now where you even look at international debt, like Nestle versus Procter and Gamble, or do you think it doesn't matter because large cap S&P, they're international anyway? Like, how do you think about that?
Yeah, so to be honest, and it was funny because Todd and I were in this meeting probably 3 months ago, and we were trying to persuade a client that they still wanted to have their international exposure. You know, there's still a reason. We got the laundry list of all the problems with it. So really, again, it's not about the decisions that we're making right now. It's about the decisions we made ahead of time. And so it's having a global diversified portfolio already, layering in these tools and going from there. You know, I think the interesting thing that we're going to be watching is how the various supply chain issues start sorting themselves out, because that's really what's being challenged here. And once again, it all comes back to this. It all comes back to more or less how one person feels about how the world should work. But the rest of the world is going to push back in various ways, whether it's the market response, whether it's things like Congress deciding, hey, you know what, economic emergencies could only last 60 days. We've seen a bill like that come up a few times. So I do think that while as unnerving as the recent turn on trade has been, if the process is to get us into talks with other countries and start sorting these things out, and you know, maybe even figure out some of these inequities that actually exist out there in trade, they're not nearly as big as this hammer was designed to fix. But you can actually start making steps there, and we can get back to just evaluating companies, evaluating their supply chains. So, you know, there will be an opportunity eventually in some of these supply chain oriented companies, and whether it's technology, whether it's in retail, apparel, industrials, a lot of these companies where people got really, really worried, they're still worried. But we do think there's tools that they can solve it going forward. So
one of the things we've talked about in the past, Joe, we've had a couple of our investors on from healthcare, right? And healthcare is still a viable opportunity. CVS, right? They're up 47% for the year so far. I mean, there's still opportunity out there. I don't know if you guys know this, but Philip Morris is also up 30% because they're going into a lot of smoke-free products. Now, I'm not recommending any individual stocks, but there are some things out there that we could still look at. Biotech is still a viable option, even despite what's happening.
I'd add one thing, Todd. I was reading a great report by Goldman Sachs on declines. And since World War II, there's been, I think, 7 recessions. And the average decline, the average is 25, the median decline is 25%. So the middlemost of all the declines, the average is 30. We're down around 18, which would suggest that if we just go to the median, we're almost there. Certainly we were there prior to yesterday's rally. We were basically at 20, I think, on the S&P. How does the magnitude of the decline, does it matter? How should you think about, like, hey, I should be more nervous? Like, I always say to people, like, it's already priced in. Like, all the uncertainty we have right now, unless it gets worse, the market's probably not going to get worse because we've kind of all expected it. My only concern, honestly, is that there's too many people still looking to buy the bounce. And typically you don't get to a bottom when everyone's saying, oh yeah, we got to buy. Like that's my concern, but maybe it's just me. I've never seen a bottom that's lasts when everyone's telling me that I should buy the bottom, you know. But Todd, your thoughts on just when did declines get big enough that people have to rethink their plans entirely?
Yeah, I mean, that's a really good study. I read that as well. And I read an additional one where it focused on the next 12 months and the return afterwards. And it's astronomical. So it just goes back to that short-term, long-term thinking where depending on where you are and how your portfolio is set up, maybe you should buy in, and it doesn't matter if you are buying in at the immediate low. You can absolutely cost average, but it really just depends on how you are managing your overall portfolio overall.
One of the things we've talked about is our viewers looking for a good financial advisor during this time, right? There's stats that say it's like this during volatility that consumers want to understand what's good advice. And actually, Google just came out with a recent study. One of the number one things that people are searching for right now on Google is what makes a good financial advisor. So, can we shift into a conversation if our viewers want to find a good advisor? Todd, what are some of the things that they should be looking for?
Yeah, so that's a really good question. I'm not surprised that that's happening right now. I mean, a good financial advisor will be a fiduciary. They will be in your corner. They will fight for you. They will give you unbiased opinions on the market and how they view it. I think that's the most important thing, is being a fiduciary. But most importantly, after that would be communication. Right now, every one of our advisors on the phone, beating the drum, trying to communicate with your clients. We don't want to hide when it's bad. We don't want to be under our desks when there is a recession or a bear market. You have to communicate with your clients so that if something changes in their life or in the market, like a macro event, like what's going on right now, maybe you do need to change up your financial plan. But a good advisor will always communicate and always point to what's going on to help the client understand how their dollars and cents are working for them most efficiently.
That's right. How often should clients be doing a portfolio check?
That will definitely depend on who is basically the advisor. I mean, I like to meet with people as much as I can. I always like to say, if something changes in your life, give me a call. We'll talk about it. We'll add it to the financial plan. What we like to do here at Grimes is at least talk to people semi-annually or annually on repeats, but that's not to say hold all your questions till the end of the year or the middle of the year. If something is bothering, if something is changing, we will absolutely proactively reach out. So I would say you can't really make an investment decision based off of one specific day. You like to see a long track record. So, at least semi-annually, annually check in with your advisor.
Yeah, I think, clients today obviously are very concerned, but staring at your portfolio all day or checking it, every other minute. And, I know clients like that really doesn't help you make better decisions. So understanding where you are relative to your goals is very important. Having that conversation with your advisor, with your life coach, but then letting it go and not forget it, not set it and forget it, but letting it go. Let's get to the next day. Watch us next week. Watch us week after week, but don't make any abrupt changes overall. And Ben, I'd really love to hear from you. What are some of the signs that that someone is actually working with the right advisor? What do you tend to see?
Yeah, I mean, the most important thing is if you're working with a good advisor in a period like this, when the world is really stressful around you, you should feel comfortable that you already have a plan in place. That's how we're set with our clients right now. That's, we can't control what the news headlines say. We can't control what goes on in the world. But when clients, if we're reaching out to them, they're calling into us. The conversations have been actually very good over the past couple weeks because of the plans we already had in place. And most of the time, it's just a reminder that, yep, this is what we're doing. This is what we're planning for. This is how your portfolio is designed to manage through it. So, a sign of a good advisor is something like this happens and you're not being thrown off your path. You plan, you're ready ahead of time, because unexpected things, it's right there in the name. They happen unexpectedly. If you could plan for unexpected things, they wouldn't be unexpected. And so the market is always going to throw these things at you, and it's having a process that's prepared for that uncertainty.
And Terri, I would just strongly encourage any advisor who's making what I'll call heroic moves is really dangerous to your financial well-being. Remember, advisors are humans too. And the thing that overcomes bad decisions is process and systems. Experience is good, education is good, having really good discipline is better. And so you want an advisor who tells you, this is what we do in good and bad. This is what our process is. As you heard from Ben, he actively has rules in place that they put in place that have been stress tested in multiple environments, none of which are heroic moves. Today's the day we're getting out. Tomorrow's the day we're getting in. That's where dangerous things happen. And I'll give you a good example of what a good advisor would be doing today. After a big sell-off like this, rather than simply choosing to say the market's going up, even if they don't have sophisticated strategies like they have at Grimes, they would be rebalancing. And they would be basically saying, okay, the stock market has gone down so much that your allocation, which is meant to be 50-50, is now 55-45 in the favor of debt. We need to rebalance. You're basically increasing your equity exposure, but not because you're timing the market, simply because now you're actually rebalancing to the asset class that's underperformed, which, as Todd pointed out, typically when it's underperformed, that's the asset class that will do better. And if you do that even within the S&P 500, if you had rebalanced at the end, like we suggested on this very show, that you balance away from the Mag 7 into value stocks, away from US into international, so that you are constantly shifting to an asset class that is underperformed, then that typically does better when the corrections come. And those are CFP level, not sophisticated. They're important. They appear simple. Doing it right matters. Doing it with a tax-sensitive perspective matters. But those are the things, again, that are not emotional. They're disciplined. Every time the S&P moves more than 10%, think about rebalancing in both directions. Because, again, you've got to be sensitive to taxes, but it's a simple way to keep your plan honest. Because as we shared last year, after the huge advance we had for 2 years in a row, people who originally started 50-50 were very probably, because interest rates went up, so their bonds went down, and equities went up 25% and 23%. They were very likely, instead of 50-50, 62-48. That's a big difference, which means that even though you intentionally want to have a 50-50 portfolio risk, you're actually at 62% risk. And that, suddenly you get the correction, the long-awaited and healthy adjustment, and you are no longer where you should be. And that's why a great CFP is always looking at your current allocation and saying, is this consistent with your plan? And it often gets lost. Yep. That decision is much more important than how you do relative to the S&P. Like the way you allocate and rebalance in a deliberate way is far more important. Just like we say to people, if you retire too early, that has a much bigger impact than if you outperform the S&P by 1 or 2%. If you spend more than you should, that has a much bigger impact. If you get sick, if some unexpected thing comes, that will have a much bigger impact. The choices you make in your life have a much bigger impact than what happens with the market or what the government does. Choosing to sell and paying taxes on it has a much bigger impact. And people were thinking in this environment, I just saw some of the questions we got, should I be selling? Well, it depends. And it doesn't depend on whether I think the market's going up or down. If you've had the stock for 20 years and you're up 400%, do you really want to give another 36% to the government right now? Because that's what you're guaranteeing you're going to do. Whereas if you could just weather out the storm and let it recover, in 3 years, you're compounding out at a tax-free basis. So it depends. And again, those are the nuances that people often ignore when they're overwhelmed by a question that nobody knows the answer to. What's going to happen tomorrow? And if any of us did, we would be incredibly successful and wealthy without having to do anything of that we do. The main goal is here to have discipline, to do really well by making smart choices with somebody who understands what discipline and process is.
Yeah,
One thing I-
Anyone who tells you to know what's going to happen tomorrow is lying.
So Joe, what we call, we often say, clients are going to talk to us. They're talking about this strategy versus the S&P, this bond strategy versus the ag. We call those basis point decisions, right?
Yeah.
The ones that matter are all the things you just listed. Those are percentage point decisions where you can impact your returns by multiple percentage points, not just a couple basis points here and there, but multiple percentage points. And that's why at a time like this, it's so important to have a strategy that you know and you understand. Because right now, changing your strategy today, when the market is behaving like this, up 5% one day, down 5% the next day, that's when you move yourself into the wrong place and the wrong model. And that's a percentage point mistake that you're going to be paying for years. So that's
I always say this: every strategy in the world goes through 18 months of underperformance. Every strategy. The biggest mistake you can make is shifting strategy at the wrong time. So value investing has been awful for years. And they go, oh, I got to be in growth investing. And they did it at the end of last year. Or you never own Bitcoin. And then it goes up 200%. Like, I now got to go put 10% of Bitcoin. And so again, I think almost everything works if you ride out a full cycle. Almost everything.
Well, I think,
what doesn't work is shifting strategies.
The most actionable advice you've given is, the S&P is down 13.42% so far this year to date. So if you haven't rebalanced, this is the time to do it. Otherwise, your risk tolerance is way off from what you originally planned. Yeah. And so if you do nothing as a result of this show today, go out and rebalance, talk to an advisor, and at least get your risk tolerance right. Because we're not done with all this volatility yet. We're not even close. Let's move into next week now and what we should be expecting. Obviously topping the charts over the last several weeks is the tariff. And now there's been a 90-day pause on tariffs for negotiation. What happens during this quiet time, Joe?
Look, first and foremost, we've heard from the Fed. They're not going to save the day. We had 4 Fed commissioners just today, 4 of them, basically reiterate what we were told by Powell. We don't have enough information to do anything about it today. We don't know what the economic effects are. We have no idea what the inflationary effects are. Now, the good news is it's very clear that today we got a really good inflation reading, 2.7, I think it is. It looks good, but the problem is none of that includes what's happening right now. Nobody knows the impact. And the Fed is very clear they're not going to move too early. So we're really relying now on the administration's talking the market up, telling us good news. And unfortunately, because of I don't want to use the wrong word, the unpredictability of what's going to be said at any minute and how much it's reliable. No tariffs are here to stay. Oh, I changed my mind this very morning. And the people in Congress talking to Congress have no idea that I've suddenly decided, no, we're going to put a pause for 3 months. Now, ultimately, we have to have faith that the administration has a strategy. It's just not obvious to anyone what that is. So I think we're about to get big earnings just starting tomorrow with the big banks. They're a great barometer for the industry. And I think we're going to hear from everyone in the nicest way possible. We have no idea what's going to happen next. Because if our Fed doesn't know, almost nobody knows what to bank on. And that for sure was the common thread. We've basically given an excuse to anyone who was going to have bad earnings to cover themselves with protection and say, well, it's not our fault. Just like COVID, if you remember what happened, the first set of earnings, it was like, we don't know. We just don't know. It's going to be bad. We don't have a clue. And right now, we've given an excuse for what I think could be a challenging week for earnings reports. Now, what I am looking for is, does the market react positively like it did yesterday when Delta said, we're not going to give any guidance? And I would have expected that would be bad, but it didn't turn out to be bad. And so it could be that we've priced in enough negativity that some of the earnings reports, some companies, if we start to see people just ignoring it, that would be a pretty good sign to me. But again, no matter what happens on any one given day, we are really oversold. We also had a huge relief rally that was a lot of it short covering and panic buying because a lot of people are levered to the downside. And so we can't put a lot of stock on these one-day moves. You just have to ask the question, we've had a big decline. 13, 14% year to date, but close to 20 from the peak. That's a pretty substantial decline. The average decline or the median decline is 25. That prices in a recession. So we've priced in a lot. And the question is it going to go, are we more than halfway? I would bet we are. I mean, if I had to guess, we're probably due for a test of 4,500. Maybe some of the big banks are calling for 4,200, but we've already suffered more than half of that already if that's where we go. And this is not a global financial crisis. This can be fixed literally with one conversation saying we're going back to the old way of being. And all of a sudden, everyone would be like, okay, phew, that was a tough few weeks. So again, I think Todd pointed this out really well. I think Ben pointed out, Terri, you have too. It could all change so quickly that you want to be very careful. Now, the longer this goes on, the more unpredictable our position as the safe haven for the world is. And I think that's something we should tread very lightly on jeopardizing, because we've built our entire nation on being the standard for the world. It's what drew me here to become a U.S. citizen. It's my home. I love it. And it's because we are a country that sets the example for everyone else. So that'd be my concern for next week. Big earnings week, obviously.
It is. We'll get the March initial retail sales and March import price index. So it'll be a big week again. But just one final question for you guys before we go. Why did the economy break up with the stock market? Okay.
I don't know why.
No.
It just couldn't handle the ups and downs. So there we go. All right. So thank you, Joe. Thanks, Todd. Thanks, Ben. Just being patient with these silly jokes. But, thanks for watching our special report. These are very.
We thought that was a real question, by the way, Terri. I'm like, has that happened? I don't know if that's happened.
Yep.
That was the whole point of it, just to make sure you guys are on your toes over there. But if you have concerns, if you have questions, please look us up. We can get you in touch with Ben, with Todd, with weekly financial advisors. And if you'd like to do a portfolio review, please go to wealthion.com/free portfolio review, and we'll have more answers for you next week. Thanks again, everyone.
Thank you. Thanks, guys. Thanks, Ben. Thanks, Todd.
Thank you.
Thank you.